are in listen-only mode.
Good afternoon or good morning, ladies and gentlemen. Good morning to everyone who decided to participate in this webinar session of The Long and the Short of It by Clive Lambert, Darren Sinden, with little help from me, Michael Onahoff. It's Tuesday, it's 11 o'clock, and we are live yet again with another fantastic episode. Today, I would like to start with our usual risk disclaimer. Please remember that trading FX and CFDs using leverage may result in a loss of all your deposit. Also, trading losses can exceed your deposits as well. My name, as usual, is incredibly difficult to remember, hard to pronounce. It's Michael Onahoff, and I'm a client relationship manager at Admiral Markets. I'm great at opening accounts for clients, so if you would like to open a demo account or a live account with us, please don't hesitate to contact me via email, and I'll be very happy to help you. It's December, the first webinar session in December actually, and to be in a very Christmassy mood, I decided to continue with our bonus giveaway. So if you're looking to invest more than £1,000, we can give you a nice 10% extra. All you have to do to get all the terms and conditions is to send me an email on mo@admiralmarkets.com, and I will get back to you with terms and conditions, and we can actually have a very nice and exciting chat. But for now, I'll pass the floor and the microphone to Mr. Darren Sinden, who will take it away with his fantastic part of the presentation. Darren?
Thank you, Michal. That's great. If I could have, yes. If I could have the screen, that would be much appreciated. Morning, everybody. Thank you for joining us today in the latest of our series of webinars, The Long and the Short of It, with myself, Darren Sinden, and my colleague, Clive Lambert. If you're new to the experience, I look at the fundamentals, and Clive takes his stance on the market from a technical standpoint. Right, well, let's get cracking. Those of you that are regular viewers will know that we start all of these webinars with a look at the markets, what is colouring the markets, what's informing our thinking, what is the mood of the markets, and that's the title of our first slide. Well, today's descriptive word or adjective is contemplative. The markets are contemplating a low oil price, a low-flation, if you like, or deflationary environment that we potentially find ourselves in, and trying to decide what this really means if it persists. Obviously, oil prices were already weak. They cratered. I think that's an unfair description after the OPEC meeting last Thursday, and the lack of a production cut. That wasn't completely unexpected, and then the markets, as I say, trying to decide what that means going forward. If we look at the chart to our right, which is I've taken it from the Blonde Money blog, but I think it originates from City Research and DataStream and Business Insider. This is a chart that shows how world equity markets perform relative to an oil market, a weak oil market, over a 5 and a 10-year period. The biggest winners over a 10-year period with a weak oil price, unsurprisingly, perhaps some of the biggest users. So the US here, very strong. Japan also, obviously, if you don't know, they are a massive importer of oil and other energy products because they don't have any natural resources of their own. Economies that do poorly when we have a low oil price include Australia, the UK, obviously we are an exporter to some extent of a producer of oil, and Brazil, and obviously over on the far right hand side, Russia, and we'll see a little bit more about Russia in a minute. So a lot for people to think about. 2015 could be a very interesting year. Somebody described the OPEC non-decision, i.e. non-production cut, as one of the biggest macro events that we've had in the last couple of decades, and I think perhaps that will pan out in 2015. So let's have a look at a couple of sound bites that have caught my eye in the press, in the media over the last couple of days. This one also from the Blonde Money blog, and if you don't read that, I can thoroughly recommend it. But the recent heroic efforts by Abe, the Japanese premier, in Japan are not a reminder of how focused the authorities are on reflating the economy, though it should be. Rather, it is a reminder that Japan's lost decade has stretched on now for over 20 years. Deflation is vicious and pernicious. Once you're in it, it's hard to get out. And I think that's going to be a theme that we're going to be coming back to again and again in the coming weeks and months. If we had any doubts about the macro effects of a low oil price and how quickly that would start to be felt, we need to look no further than what happened in Russia yesterday. The ruble suffered its biggest one-day decline since 1998 as oil prices continued to fall on Monday, escalating fears about the Russian economy. The currency slid almost 9% against the dollar before rallying after suspected central bank intervention. And that clip from, or soundbite from BBC News. Yeah, a dreadful day for the ruble yesterday against the dollar. We did flag the potential for that back in mid-October, but certainly those chickens are coming home to roost now. Okay, and our third slide of this part of the presentation, what the money thinks. And here we take a look at what the clever money, what the large sums of money that are institutionally managed are thinking. We'll take our text today again from the Bank of America Merrill Lynch Global Fund Managers Survey for November. Just for your guide, they every month they survey around 570 fund managers 270 fund managers that control around $570 trillion of assets. Here they asked people what they were pricing in for 2015. 77% of survey respondents are pricing in a world of below trend growth and below trend inflation for 2015. 71% of respondents said that deflation was a greater risk next year than inflation, where only 16% of people felt that inflation was the issue. The chart or table to the right, that's drawn from the Wall Street Journal, and it just shows a couple of charts about CPI Eurozone and Japanese CPI falling away again in December, suggesting that inflation is dying, non-existent. And even in what has been one of the most powerhouse economies of the last year, India, growth is slowing, and in Brazil it's possibly almost sort of flatlining. So emerging markets are feeling the pinch too, as well as developed markets, and the Eurozone and Japan, as you know, we think they look more and more alike, and we think that's the trend that's likely to continue as well. Right, so let's get to the meat on the bones, as it were, of today's seminar. Probability and its relationship to risk. Now, in all of these topics that we cover in the webinars, we are constrained for time, so probability is a subject that we could talk for weeks about. I don't propose to say too much about the actual maths behind probability, but there's plenty of background reading you can do about that. But what I do want to do is focus on a little bit of an understanding how we should approach it and how we can apply an understanding of probability to our trading. So probability is actually an everyday occurrence. We all face and assess probabilities each day, whether we realize it or know it or not. We assess probabilities when we cross the road, or when we decide what time to leave the house in the morning to catch that train or bus for work, or to drop the kids off at school. And we make a decision, subconsciously perhaps, but we make a decision based on our experience of the real world and the probability of a change or deviation from that. So if we know, if they're experienced that if we leave after 8 o'clock the traffic's going to be heavier, we probably leave at 7:45. We don't obviously step out into the road knowingly to be run over by a large and speedy lorry. So probability and decision making and an assessment of risks and likelihoods of change are decisions that we face and make every day. Probability and risk effectively can be thought of as being two sides of the same coin even. They may sound like totally different concepts, but in fact they are closely related and can often be said to be interchangeable. An example of that would be when we buy an insurance policy, we insure ourselves against a specific risk or event, such as death, ill health, theft, fire or flood, or the birth of triplets. The insurance company that sells us that policy takes on that risk and sets its price or premium based on the probability of that risk occurring over the lifetime of the policy. The premium rates are calculated through the use of actuarial tables and models, and these are tables of probabilities and distributions, and we'll come on to what that means a little bit later on. But the net of this is that's why we have higher motor insurance premiums for young drivers who have a higher probability of having an accident, or a higher life insurance premium for someone who perhaps is an aging smoker and is keen on dangerous sports. And I'm not having a dig at you there, Clive, but cricket can be quite dangerous, as you found out earlier this year.
Yes, less said about that the better.
So what are our perceptions of risk and probability? Well, let's just have a look at some of the numbers. The chances of winning the Euro Millions lottery, one that many of us I'm sure will play every week, the chances of winning a prize could be as low, or as high rather, as 1 in 23. So 1 in every 23 plays you could potentially win a prize. Winning the prize, the main jackpot, however, has a likelihood of 1 in every 115 million plays, which is of course why we're all still sitting here listening to the webinar rather than being on a yacht in the Caribbean. Some other interesting stats: the chances of being struck by lightning in the USA are as low as 1 in 700,000, but the chances of being struck once in your lifetime, assuming you live around 80 years, are as high as 1 in 6,000. Quite significant, that. Chances of being attacked by a shark, something that most people are paranoid about, as low as 1 in 300 million. So you're very unlucky, and it's very unlikely that will ever happen to you. But the chances of being killed in a road accident, as high as 1 in 8,000. People don't seem to have a phobia of getting in the car, crossing the street, or riding a bike, but much higher chance of being killed, or probability, if you will, of being killed in a road accident than there is of being eaten by a shark. Perhaps we should modify our behaviour, and again we're going to come on to that idea shortly. So moving on to our next slide, it has transpired that human beings are actually programmed to make the wrong choice more often than not, and it's nothing that we can do too much about without applying some logical thinking. But psychologists Daniel Kahneman and Amos Tversky showed that humans are programmed to make the wrong choices because of the way our brains function. And in their paper, Prospect Theory, Decision Making and Cognitive Biases, they showed why that was true. Now, again, I won't spend too much time on this, but it's a well-known study, and in fact it won, although the paper was written in 1973, it won a Nobel Prize for Economics in 2002. What's interesting there, of course, is that they were psychologists, not economists, and Daniel Kahneman says he's never had an economics lesson in his life, but it was what's probably regarded as a seminal work on human behaviour, and it really started the whole field of behavioural sciences. Their work followed earlier experiments which compared the performance of rats versus humans in decision making. Clive, do you want to come in there?
I was just sitting here wondering whether that won the Nobel Prize for Economics in 2002, 30 years after it was published, because somewhere in that 30 years a lot of things happened that sort of proved what it was saying. We've seen a lot of I think in the 70s and 80s it was very much all about academia thought the markets were very much all about mean reversion and random walk theory and that kind of thing, whereas in the interim period it suddenly discovered that markets were irrational, and that psychology had a hell of a lot to do with it. So I think that's maybe why it took so long for that to be recognised, that the cognitive side of things was recognised as something that you could apply to the markets and that kind of thing. LTCM being a classic example,
I think that's a very good point, Clive. Yeah, exactly. The theory was made, and then the market and the world moved on, and it was clear that I think that's exactly right. It was clear that the work that they'd done actually was applicable and was very, very likely to be correct. So yeah, good point, Clive, and one worth considering. So as we said, their work followed earlier experiments which compared even the performance of rats versus humans in decision making. Quite an interesting example here. In a simple game, a sequence of red and green lights would randomly flash 10 times, perhaps in the order 6 green, then 3 red, then 1 green. Both rats and human subjects were exposed to these random sequences and asked to predict the colour of the next light. Obviously the rats didn't speak English, but they were rewarded with food when they predicted it correctly. Rats observed, and very shrewdly, that there were more green lights than red during their exposure, and predicted green every time to win a food reward. Now they obviously weren't right every time, but given that there was a 7 out of 10 chance of being correct, they got quite fat quite quickly. Humans, however, because of the way our brains are wired, ignored that bias and tried to work out the pattern of flashing lights, and were invariably wrong. So rats have outperformed humans in the decision-making process, not necessarily by being cleverer than humans, but just making a more logical choice and working out that they could get fed if they predicted a green light, because the green lights were the ones that occurred most often. So our perception of the world is flawed. It's quite a hard thing to take on, but that is the basically the subtext, if you will, of prospect theory of Kahneman and Tversky's work, that the way we perceive the world, the way we use our perception of the world to make decisions is flawed, and our cognitive biases let us down. So here's a question for you. Which is the largest set of numbers? Is it the whole numbers, i.e. integers, between 1 and infinity, or all the irrational numbers, irregular decimals, recurring decimals if you will, between 0 and 1? Now have a think about that for a few moments. So I'll just take a sip of water. Right. Which did you choose? The integers between 1 and infinity? Well, if you did, and you probably did because it sounds like the most logical answer, you were wrong, I'm afraid. Again, we won't spend too much time on this, but mathematician George Cantor, who died in 1918, showed that there are infinitely more irrational numbers between 0 and 1 than there are integers between 1 and infinity. Again, we won't say too much about it. I know it's a very strange concept, but it's an extreme example, but it just shows how easy it is for us to make an assumption about the world and for that assumption to be wrong. This doesn't have any practical day-to-day application, but it's just an example of where we might go wrong about what the real world looks like. So with all that in mind, we need to consider how we can apply probability in our trading and what we need to focus on within that. So we'll do that with the help of a few simple diagrams, stack Venn diagrams these happen to be, but this diagram opposite shows us a hierarchy of possible events. So the larger circle here, and it could obviously be much larger than this, but we're constrained by space, these are all possible events that could happen. An asteroid could strike New York tomorrow, a tidal wave could consume Tokyo, we could invent free energy, and all the world's problems can be cured overnight. So those are all possible but unlikely events. All possible events is the largest set. But what we need to concern ourselves with really is not the possible, but we need to focus our attention onto the probable when trading. We don't need to consider all possible events, rather we should consider the smaller set, the much smaller set of all likely events. What's likely to happen? What are the things with shorter odds, if you will, that can occur? Not all possible events, which of course could be infinite in themselves, and and some are particularly unlikely to occur. So let's have a look at why we might want to consider only the most likely events, and the way for us to consider that visually is to consider a bell curve or standard distribution. Now, as Clive's already said, there's been a lot of work done in modern times about different sorts of distributions and how that might be applicable to the market, but for our purposes here we can just concentrate for the moment on a standard distribution or bell curve. And the key to this standard distribution is quite simply that 95% of the sample population, i.e. the statistics, whatever we're looking at, the number of people over 5'10" tall, say, or the number of left-handed ladies with black hair, the sample distribution, the distribution of the sample, 95% of that, whatever the statistical group is, will be contained within 2 standard deviations of the mean. Now, standard deviation really is simply that, the the normal deviation away from the mean of the sample group. So 2 deviations away from this middle point in any sample group, as far as the bell curve is concerned, will contain 95% of all of the samples within the study. So what does that mean for us? Well, one thing we need to consider, again Clive touched on this, and again there's some debate about whether mean reversion is applicable, but over time, as far as we're concerned in this instance, events trend back towards the mean, and the vast majority of our sample, of our list or data set, will be contained within these 2 standard deviations of the mean. So that means that we need to narrow our focus, and in trading we need to concern ourselves with a subset of the most likely events on a day-to-day basis. So all likely events, and we focus now on the most likely events, which are those that are going to fall within that 2 standard deviation distribution on our bell curve. However, we must acknowledge in our risk management the occurrence of the so-called outliers or black swans, and those are things that are more than, well, typically 4 or 5 or even 6 standard deviations away from the mean. And of course, in the markets, I'm thinking here of things like the credit crunch, or the crash of 1987, the Russian crisis of 1998, as Clive said, the blow up of long-term capital management. Those would all be examples of black swans, events that were thought very unlikely, but actually did occur and actually did have a profound effect on the markets. And that's of course why we would encourage people to trade with a stop loss, to limit the losses, not just from a standard money management point of view day to day, but also to protect themselves in the event of one of these black swans coming into view, because they tend to appear out of nowhere and have a profound effect on the markets, creating massive volatility and dislocation. Okay, so here is a Euro-US dollar 15-minute chart drawn on MetaTrader 4. Quite a simple chart, and all I've done is add some annotation. So we've got a gently sloping trend line here. We've got we've highlighted the high of the day, we've highlighted the low of the day, and we've drawn some tentative lines of support and resistance. But that's the sort of chart that anyone might be looking at when they're considering perhaps entering into a trade and wondering what they should be doing in terms of stop loss placement, etc. So if we think about our chart, the candle chart there of euro dollar, and we're thinking about entering a trade, we might also want to consider that bell curve distribution when we're thinking about where we're going to place our stop. Now this is, this graphic here is meant to illustrate that very point. This is the potential range of prices in euro dollar from 75 up to 150, but obviously that range is open-ended, at least to the right-hand side, bounded by 0, of course, on the left-hand side of the arrow, but we'll just look at the area between 75 and 150. This is, if you like, theoretically where euro dollar is trading, and this band here represents what we might think of as the average range of euro dollar. So how many ticks in an average period would euro dollar move? Now in our example, we had a 15-minute candle chart, didn't we, over one day. We knew the high and the low. Once we've established the high and the low, and we can do that over a number of periods, we can then work out what the average range would be for euro dollar or any instrument. And as Clive, I'm sure, will tell you, average true range, which is a technical study that does all this for you, is used very widely, particularly by futures traders, to work out where they should be entering the market or where they should have their stop losses placed. So, given that we now have an approximation or know the average range of euro dollar, we can then decide through the application of the bell curve what are the standard deviations. And as we saw from our bell curve, 95% of all of the sample, i.e. the 95% of the ranges that euro dollar occupies in our sample period, will be contained within our 2 standard deviation range. So do we want to place, if we are in order and we're thinking of putting a stop loss in, do we want to put our stop loss in here inside 1 standard deviation? Possibly not, because we're almost certain to be stopped out if we place our stop within that area. Do we want to place it outside of 2 standard deviations? perhaps we do if our money management rules will allow us. And there's no right answer to this. You know, each trade and each trader will have to make their own decisions. But the reason that you see lots and lots of stocks being, you know, clustered together and being taken out either up or down by a moving market is simply this, that most people will place their stops and make the wrong decision, probably for them, within this one standard deviation area of the average range, or maybe within the average range itself. You're absolutely certain to be, unless you're very lucky, to be stopped out. More if you place your stop loss in this area, less likely, but still fairly certain to be stopped out if you're in here within a standard deviation. You're still well within, you know, the majority of the sample group. And again, you know, there's still a very high likelihood of, you know, of being stopped out here. Although obviously we've got to see the average. You know, we've got to see euro dollar break out of its normal range, or its average range to take out our stop here, and so you may well want to consider, you know, a placement of a stop in this particular area, or even outside of two standard deviations away. So that's quite a complex thing to take on board. But we think about, you know, we'll just go through it again. The majority of the distribution, if we could plot our bell curve here, would be within these two standard deviations. This is where in our sample group the average ranges are. We're going to put our stop loss within that, where the closer we are to the average range, the more likely we are to be stopped out. As simple as that. The further away we are, the more chance we have of staying in the trade. But obviously the further away our stop is, the more money we are risking. So we've got to temper those two elements when we're talking about probability of being stopped out. There's no point in, you know, in putting a trade on and having your stop one tick away, is there? Because you'll definitely be stopped out. And you can see, you know, if we've got a 40 tick average range, then, you know, a 20 tick stop is also quite likely to be stopped out. Perhaps one that's above 40 ticks away, well then you know, it's got to deviate from the average before you're going to be stopped out. So I hope that that's giving you a flavour for probability in trading, what it means. As I say, there's plenty of background reading to be done. There's lots of articles about the Kahneman and Tversky work, and I would encourage you to go away and do some reading about that. If you've got any questions, or you would like some recommendations for, you know, background reading on this or any of the other subjects, then please do get in touch with Mihail, and he'll pass those questions on to Clara and I, and we can hopefully come back to you with an answer. I think I'm right in saying that I've basically used up my time now. And so without any further ado, I will pass you over to Mr. Clive Lambert, who I believe is going to take us through some live charting and show us what he's looking at in the markets today. So thank you very much for listening. Hope you found that interesting, and I look forward to speaking to you all on Thursday.
Thank you very much, Darren. Always interesting, always on the button with respect to sort of, you know, the nuts and bolts of trying to, you know, work out that jolly old thing of trading the markets. You know, it's not an easy thing, and this kind of thing is useful to sort of help people to get a better idea of what the risks are out there, if you like. Now, I just want to find the right monitor. It's that one there. Okay. Okay. Yeah, I think I've sort of advertised today as a live market session, having a look at live charts. I'm going to do that. There's a few interesting things that have happened over the last few days, but I thought I'd try and also frame it, if you like, with respect to Darren's topic of risk. And so I've got a slide here, if it will work. Come on, go, turn over. Okay. First thing I'd say is technical analysis. Much is often, yeah, I've been described over the years as a stargazer, a crystal ball gazer, that kind of thing. All that's rather disparaging, but I've got a fairly thick skin, I can handle it. And I've said to people over the years, well, no, hang on. Well, you know, technical analysis, as a technical analyst, I'm not actually trying to predict the future. I think when we first started these webinars, I may have well have done a sort of intro to TA and talking about the 3 basic tenets of technical analysis, one of which is that price action is repetitive and we see recurring patterns of behaviour in the market. Now, if you see things happening over and over again in a similar market, if you see certain patterns repeating themselves, then you can say that there is an increased possibility or probability that that sort of behaviour may occur again in the future. It's a little bit like one of these disclaimers that you get that you know, past, what's the old classic when you get on the funds and stuff, past behaviour, past performance is not an indication of future performance or something. You know. Well, that is the the disclaimer with that. You should things don't work 100% all the time, but look, if you see recurring patterns of behaviour, then you can have a you can make a reasonably safe assumption that it may well occur again in the future, and that's what we're trying to do as technical analysts. We're weighing up the probabilities and seeing if they're trading ideas that take advantage of opportunities that the chart suggests. You know, and the questions you should be, you know, you're looking at when you're using a chart is something like this. It looks like, you know, does it look like it can go up easier than it can go down, or vice versa? It's about how easy a market can travel in one direction or the other. And have I, you know, can I identify a price where the reward to risk stacks things in favour of a trading opportunity? Reward to risk, we talked about this in previous webinars. Darren's done his thing with this, and it's one of the essential things to understand, in my humble opinion, with respect to trading, is the idea of, you know, every time you're putting on a trade, you know, you want to be able to see that the potential reward is greater by at least 2 or 3 times than the amount of money you're risking on that trade. And so they're the couple of things you should be looking to achieve with respect to when you're putting a trade on. Now, I've always been of the opinion that you are much better off looking to trade in the direction of the trend. And it's an old NAF catchphrase that us technical analysts use, that the trend is your friend. And you know, I'm a firm believer in that. And so let's, you know, well, yeah, let's go to our charts now and see if there's something on there that I can, you know, that can illustrate that for me. Okay, come on, escape, get out of there. Show me my charts. Okay, we're having one of those sort of tiny little glitchy days, are we? First thing I want to look at is the Australian dollar against the US dollar. I had a little go, had a little trade on this earlier today. Oh, come on, machine. It's having one of those temperamental days. Here we go. Right, first chart I want to show you is a weekly chart for the Australian dollar against the US dollar. There it is on our screen, and I think it's reasonably safe to say that, you know, the market is going down. If we're looking at that particular time frame, we have a chart. If I can, you know, I can increase the scale on it, and we can see we're going from the top left to the bottom right. I think it's that's a sort of classic, you know, bearish chart, no doubt about it whatsoever. And so, if that's the case, and that's a weekly candlestick chart, okay, every single candlestick on there represents 1 week's worth of price action. And this is the exercise I do every day. You start off looking at the weekly chart to give yourself the context, if you like, and to say, okay, what's the overall trend here, and which is it, you know, because the idea for me is that you try your best to put on trades. It's easier and better to put on trades that are in line with the trend. You've got more probability of making money in general if you try to go with trends as opposed to against them. The analogy I may have used in previous webinars, but I often use to try and visualize, you know, this concept is I say to people, yeah, because we're based in London, I say, which way do you want to be walking across London Bridge first thing in the morning? Okay, now there's a station on the south side of London Bridge well, called London Bridge Station. And so there are a whole heap of commuters from South London who get the train into London Bridge Station and then walk northwards into the city. So you have a huge flow of human traffic going northwards during, at that time of day, first thing in the morning. And my question is it easier to walk with that crowd of people or to walk against that crowd of people? And I've only ever had one answer that was slightly strange. I was doing this for a bunch of proprietary traders who had a policy if the traders made a certain amount of money, whatever time of day it was, then they kind of said, right, you hit your targets, off you go. So one of the young lads went, I want to be going against the traffic. I want to be going south. And I said, well, sorry, I think you must be missing the point. What do you mean? He went, well, that means I've made my targets for the day and I can go home. So, yeah, nice one. But I think you kind of missed the point of what I was saying. It's easier to go in the direction of the trend if you are trading, and hopefully you get that idea. Now, weekly chart says we're going down. Let's go to a smaller time frame now. Let's say we'll have a look at the daily chart. There's the daily chart, okay? Daily chart says we're going down, okay? We've had a couple of periods of consolidation of late, but the market is still making lower highs and lower lows. Remember our classic Dow theory thing. A couple of days ago, last week, we did try and head higher on this day here, but then sold off and closed back at the lows for that day. So that showed that little what's known as an inverted hammer, showed signs of life from the bulls, but we didn't get any kind of confirmation there. I can spread this out to give you a bit more of an idea. That long upper shadow said to us that the market found sellers, if you like. This morning, well, yesterday, we actually posted a doji candlestick, small body, and that may have cast, again, that's a potential reversal signal. But actually then, this morning, we tried to rally. There was a RBA thing overnight. The market had this move up to here, and it was around here that I identified that we'd posted a shooting star candle. And I thought, interesting, okay, let's see what happens. And I actually sold the market around here at 85.16 this morning. I actually bought back here at 84.75. I was around, it was just before we were getting cracking with this, and I am not a big one for trying to multitask. I am not a female, and therefore I am not very good at that. So I decided to just take some profit on the trade. That's my prerogative, and maybe it was the wrong decision, but we've carried on going lower. So the shooting star was a reversal, a bearish candlestick, as we'd hit resistance, and it appeared, okay, and so it was giving us a sell signal. And if we go to the bigger picture charts, it's a sell signal. Look at this low here. 85.41 was the early November low. Today's high, 85.45. Okay, so that shooting star appeared just when the market peaked through that level but couldn't sustain that. Weekly chart says we're bearish. Daily chart says we're bearish. And the 30-minute chart gave us a bearish signal. That's why I took that trade. Now, moving on from this whole sort of, this concept of trading in the direction of the trend, and moving on from what Darren's already said about this idea of our brain being wired, if you like, to sort of almost just wired to make the wrong decisions, if you like. It is common in the study that Darren cited, and a lot of work that's been done since has basically come to the conclusion that as human beings, fear and greed rule our world, and the way that manifests itself with respect to trading and traders' behaviour is that people will generally try to run. If they start to lose money, then they stay with the trade and hope that the market will come back. If they make money, their tendency will be to just take the money off the table quick, grab the profit. And actually the best traders in the world, I'm sure repeating myself here, but it's worth repeating, I think. The best traders in the world are people who actually turn that around, or find a way to turn that around, and to actually stay with winning trades as long as you can, and get out of losing trades very quickly. Another tendency that traders have the world over, and in particular newbie traders, if you don't mind me calling it, anyone new to trading doesn't mind me calling them that, is to try and pick bottoms or tops in markets. Okay, and this again comes back to what I've got on the slides here. For me, that is not the way to do things. For me, there it is. The trend is your friend. As long as if you're aware of the bigger picture, then you can avoid this idea. An old classic phrase is, what do bottom pickers get? Now, that's the rude version. Let's try and keep things clean. What do bottom fishers catch? Generally, the answer is nothing. Okay, it is a dangerous game, in my opinion. There seems to be a huge temptation, if you like, to try and do this sort of trading where you say the market's coming off, and so I'm going to try and buy it, and the market's coming off, because things are cheap. Okay, and look, let's go through this. This is Brent crude oil. I shouldn't have told you what it was actually. This was Brent crude oil in July, okay, and it looked like we may have been bottoming out and turning up at support. And some people may have considered that that was worth buying at that point. I can tell you, actually, I looked this up last week because I was just checking on something. I turned bearish of this particular market. Where's that price? I think it was somewhere here, and never looked back. Basically, I've been bearish ever since. But look, because this is what's been going on. Okay, so you may have been tempted to buy the dip here. You may be tempted to buy the dip here. Okay, we're seeing some candlestick reversal patterns there, but never confirmed. Okay, let's keep going. Oh, okay, we're tempted to buy the dip there. That's called a bullish outside day or a bullish engulfing pattern. We talked about these. It's a powerful pattern. Did that make me turn back bullish? Did that make me want to buy the dip? Did that make me want to get long? No. I still wanted the market to do some more to prove that to me, if you like, and to say, yes, okay, this is a bottom. And I've been seeing loads of it, and then we carried on going lower, There's another potential. There's sort of piercing pattern. Didn't work. Market made a new low. Okay, look, are you getting my idea? Now that chart's bang up to date, and I'll bring the scale on. I'll bring the scale in so that you can see. Put it into some context. I saw a load of talk yesterday that, after the market started to recover from its lows. I mean, it was a big recovery from the lows yesterday in oil, and it was also in gold and silver. And I saw a lot of people. I've seen a lot of people this morning say, "Oh, okay, is that the low? Are we in? Is that the low in? Can we buy this dip? Is that are we done now?" And I looked at my charts this morning when I was writing daily reports on these things, and in Brent crude oil, I said, "No, not yet. I'm not going to turn bullish just yet. I want to see us take it. I want us to see it proving it. Prove it to me." There's a Marabuzo resistance there at 75.11, and this 76 level, it was the low there. Broke very cleanly on that day there as well, if you look at the when you get down to the smaller term time frames. So for me, the answer is no. This isn't a dip buy. This isn't an opportunity to get long and strap it on forever. I honestly think that the trend will continue lower. I'm willing to be proved wrong. And I will be proved wrong if we can take out these resistance levels here and here. So that's that's what you're asking whenever you see a candlestick reversal pattern, particularly a one-day effort, if you like. Your next question is prove it. I think it's very difficult, very dangerous just to use it as an excuse to do that bottom fishing trade, if you like. So keeping things topical. Keeping it on, trying to stick to my brief of looking at live markets, if you like. Gold. Very interesting market at the moment with lots of people interested in gold. That is a monthly chart for gold. Okay, and we can see the really strong run up that we saw from 2000 and actually let's get that 2001 through to 2011, and then if we were, to put it into some context, we've given back around 40% of that move and are currently trading at just below 1200. If we go to a weekly chart, we can see, no, we can't see anything because I'm messing, my charts are getting messed around. Sorry about this, people. Let's get this sorted. Sometimes they get the better of me. Weekly chart shows that actually the last, this whole period from the middle of 2013 downwards, we've been drifting lower, if you like, drifting lower, but still making lower highs and lower lows. The latest lower low being that 1130 low at the beginning of November. Now, again, yesterday, we're going through the time frames here. We've looked at the monthly, we've looked at the weekly. Let's look at the daily. Here's the daily chart. Daily chart says that yesterday we saw this massive move. 1141 the low, 1221 the high. That is a serious reversal, if you like. That is a bullish outside day. It's a bullish engulfing pattern, but it's only one day so far. One day. And so my poser to the market, to the bulls, if you like, so they're saying it could be a bottom. I'm going, well, okay, prove it to me. And so far today we haven't seen that sort of evidence that it is indeed a bottom, and a couple of levels I'm watching with respect to that. One of these is our Marabou's, our friend here, 1185. This is where you can go to the more down to some shorter term time frame charts, and you can say, okay, well, what does it look like here? We've got a volume. The most actively traded price in the last 20 days is 1198. For me, we need to make a decision whether to be above or below that and filling in here or trying to fill in up here on that volume distribution. We're going to look at this in the new year, actually. A very useful trading tool. But look where the breakout point, if you like, yesterday afternoon once US trade got underway is 1184. And that may be a level that's familiar to you because we look at the daily chart, our Marabou's line is 1185. So for me, that's one of the key levels. And if we get back to there, we could see some buyers returning. If we do not, then I expect us to go back and revisit the lows. So I honestly think that at the moment, if you've got no trade in gold and you're on the sidelines, you may be best just waiting to see. It's very, very choppy. Have a look, see what happens at 1185. Have a look what happens at 1200, and we'll work out from there whether there is a trade to be done. But for now, there isn't a trade to be done at the levels we're at right now. Okay. Anything else we want to look? Let's have a quick look through through some of the FX charts. We've got another 10 minutes to have a chat with you about some stuff. So there we go. We've got Euro US dollar travelling lower in a downtrend channel there, and respecting the top of that channel quite well. So we are bearish for choice on that one, but it's stuck in the middle of a sideways range, if you like. And so that's what's happening there in the Euro US dollar. In cable, we have a similar situation going on, really. There's a potential pattern that's shaping up here called a double bottom, although we had a similar pattern last week and it only worked for a limited time. We've come back down here, and yesterday's low was very similar to these previous two lows here, and so we're going to keep an eye on what happens if and when the market gets to 158.27. But a lot of these majors at the moment, a lot of these dollar-based majors are in a bit of a chop zone and not really giving you any really clear opportunity. Euro sterling is a classic example of something. Look at this chop we've been seeing here for months and months and months now. And we're right bang in the middle of this chop zone, and for me, there's yeah, that's a dangerous one to be playing at the moment. I still like the idea of trying to trade the yen crosses to the long side, so you're paying the yen to the short side. And this is an you're going to like this one, Darren. And yesterday I suggested a trade. What time of day was it? It was before. It was when the market was somewhere around here. This is what I was looking at, and I was looking at some strong support levels. You know, I thought that was going to be a strong support level, and that was going to be a strong support level, and there was another reason why I thought 1195 was going to be a strong support level. This was the chart I was looking at, and I said, I think we could buy a dip to around here, which will be protected by these support levels here, here, and here. And then things got really choppy. Okay, went all up to there, came back down to 07. We were long. And I thought, okay, that's fine. Our stop is down here, below 90. Actually, was where I placed the stop. And have a look at that. Bang! I actually got stopped on the low of the day. I lost money on the trade by getting stopped on the low of the day. And my colleague who writes the FX analysis with me, she turned around to me and she said, well, it was a very tight stop, wasn't it? You know, this is a volatile thing. And that kind of comes back exactly to what Darren was talking about earlier. We're looking at a market that has, you know, this sort of thing, 100 point moves on the day, 100 pip moves, is not unusual. And so really, actually, yeah, hands up, I got this one wrong. And the reason I got it wrong was because I probably placed the stop too tight, considering the volatile nature of that particular currency pair. So you know, there's a case in point, if you like, of why how the volatility can bite you on the backside. Obviously, of course, what's happened since the market has traded higher. I'm hoping a couple of my clients get this stop a little bit wider, but I'm not entirely sure. I haven't heard from too many of them, so yeah, that's one of those things. And I got undone, if you like, by volatility, and not really. You know, I got it wrong. Got it. The mistake I made with that trade was having my stop too tight. And there we go. That's the kind of thing. When you do a trade, when you do any trade, you should go, what's this telling me? What lessons can I learn? And every time you do a trade, if you can learn a lesson or two, depending on the result, then that's the way to go. Darren, have you got anything that you kind of want to talk about or add before we sign off?
No, I think it's been very interesting to try to see, you know, once again the application of you know, support resistance, the Marabizzo lines have come into their own yet again, and I think it's clearly going to be a very interesting talk when you move on to market profile, something that I'm very keen to learn more about, and I'm sure the audience will be too. So no, it's good to hear. You know, sorry that you didn't win money on that dollar yen trade, but it's, you know, it's interesting to see that even professionals, you know, need to perhaps go back and see where they went wrong, or you've realised where you've gone wrong.
Oh,
so next time you'll be more well informed, and you'll place your stops accordingly.
Yeah, I think you never stop learning. That's one thing.
No,
sure.
no, I think that's very true. You know, every day is a learning curve. You can always learn more, and you can always be reminded of lessons you've learnt before as well. And often you get reminded by losing a few dollars. It's you know, but that's the way of it, isn't it? You know, it's a lesson that stings a bit, and you know, it will stick in your mind, and you know, next time you'll place your stop accordingly. Just to say though, in fairness, we're going to talk about volatility on Thursday, and I'll just give a little, you know, people have probably seen this anyway, but dollar yen is not unsurprisingly the most volatile currency this year, in a year when volatility in currencies is up sharply anyway. So you know, if it was going to happen at all in that situation, it was going to happen in dollar yen.
Yeah, yes indeed. Choose your targets. carefully, maybe.
Yeah. Well,
Okay.
that's another lesson, isn't it? You know, knowing which battles to fight and which ones to ignore. I think you said at your opening slide that you don't have to be in the market all the time.
Yeah.
You know, pick the opportunity, pick it when you believe that the risk reward slanted in your favour, and and improve your chances of making money with a sensible placement of a stock. And if you can get into a mindset where you apply all these these rules, maybe there's only half a dozen of them that you need to think about. You need to distill it into that. But if you're applying those, then you're slanting the odds in your favour, and if you do see them move in the direction that you picked, which hopefully is going to be following that trend, then you should be able to make money if all things being equal.
Yeah,
and more importantly, make money more often than not. It's not just
well, most of it's about discipline, isn't it?
all of it.
That's the word I hear all the time, is discipline. Patience is discipline. Stock placement is discipline. There's so much of it comes down to discipline and making sure you're not just sort of running around shooting arrows at anything that moves,
Yeah,
Anyway,
absolutely.
thank you very much to everybody, and I for one, I'm just going to, I think we're done for the day, and thank you very much for everyone for listening. Cheers.
Thanks, guys. Speak to you on Thursday morning. Goodbye.